Ahead of that, how is the current tightening lending environment impacting consumers and small business in accessing credit? And with tomorrow's budget inching closer and the country's property market still in decline, what housing affordability measures are in place, considering the data from today's CoreLogic Home Value Index? Well, for more to unpack some of these issues, Anthony Landahl, Managing Director at Equilibria Finance, joins us in studio. Anthony, appreciate your time today. So much has been made about the benign, you could say almost negative sort of environment as far as consumption confidence is concerned. Property seems to be one of the key issues at play. Ahead of the budget, we'll get to some potential measures. Your thoughts on how the lie of the land as far as the lending environment, the credit availability environment?
Yeah, sure. The credit environment has definitely tightened up. There's a number of reasons for that. We've obviously had out-of-cycle rate increases by a lot of the providers due to increased cost of fundings. We've got the backdrop of the Royal Commission, where the appetite for access to credit is definitely tightening, and we've also got a backdrop of an election cycle coming up with potential policy changes of negative gearing, changes to halving of the CGT if there's a change in government. So there's a lot at play, and fundamentally what we're finding is that credit is getting harder to access, the credit environment is getting more difficult to navigate, and the forensics around applications is getting a lot more detail and in-depth.
Listening to the bank CEOs, the two that fronted the standing committee in Canberra last week, they were asked the question repeatedly about the lending environment, and they, Shane Elliott's and Phil Cronican from the NAB said, look, we're lending the same. There is no restriction on our behalf. The issue perhaps is the amount of hoops, I'm paraphrasing here, that those applicants have to go through, as opposed to the amount that we're actually willing to lend. So it's more of just the forensic side and the application process versus anything from the banks tightening the lending.
Yeah, there's a couple of things at play there. There's the actual amount of credit being sought by consumers. Yeah. Consumer sentiment's down a little bit. There's a lot of uncertainty with investors. Investor growth in February was 0.85% year on year, which is the lowest annual growth since 2015 for investors. And owner-occupier credit growth is 5.9%, which is the lowest since a similar time frame. So what we're seeing is a couple of factors at play. We're seeing a tightening credit environment from the providers. And that is, as you said, James, jumping through a lot more hoops to get the credit. So it might be taking longer. We're seeing softening valuations, so clients may not be able to actually do the transaction because they don't have the equity in their property, if they're, for example, refinancing, or even if they bought off the plan a couple of years ago. There are people having issues with softening valuations on a property they purchased a couple of years ago. And then you've got the backdrop of the bank's actual credit policies and some of the forensics, meaning it's taking longer to get credit, or some consumers aren't actually getting the amount of credit they've applied for.
The question here, though, I mean, we'll get to budget in a moment, the potential fiscal stimulus that could come out of that, and of course a change of government which could bring more issues to the property market. But in terms of the RBA, there is a rate cut being, or at least a couple of rate cuts being priced in now by the market.
There are.
How do you expect that to impact the picture of lending? Because if the banks don't pass it on, and yes, we're hearing that they're having easing wholesale funding pressures now, but it doesn't necessarily mean they'll pass it on. Do you think it will have an impact on this part of the market, consumption and housing?
Yeah, that's a good question. So National Australia Bank, for example, they're forecasting maybe 2 rate cuts over the next cycle. What will be interesting, exactly to your point, how much gets passed on to the consumer and how much gets passed on to the shareholder. Now, at the moment, we're seeing, particularly in the consumer lending, a lot of very competitive fixed rates, but we're seeing variable rates moving out of cycle. But if the banks want to encourage that growth in the market and bring those home buyers in, I think they're going to have to pass some of that on to the consumer and not all of it onto the shareholder. And they're going to be under pressure to do that with the backdrop of the Royal Commission and also with the current environment around credit.
Would they be better served? I'm not suggesting this is likely to be able to get through, particularly in light of that Hayne Royal Commission, but is there an argument to be made that rather than passing on more of the rate cut, they should actually lower the stress-tested interest rate with which they overlook mortgage applications, which is at 7%. And if they even did that down to 6%, suddenly there's more access to finance, and we're at 1.5%, potentially going down to 1%. 6 or 7%, the chances of us getting there, that's still a pretty decent stress test, isn't it?
Yeah, the assessment rates In fact, some providers are up around 8% as an assessment rate for obtaining credit.
I think we're a while off 8%.
So, yeah, but that's right. But that's a good point, James, in the sense that that is another mechanism to free up credit, is drop your assessment rates. And also some of the providers are now using different assessment rates around living expenses. They're looking back over 6 months of history. They're looking much more into the conduct of repayments and the conduct of the customer. And they're reviewing HEM as a benchmark measure. So that is a mechanism they could do. Will they do that? I don't know. That's hard to tell. But assessment rates are hovering around on average about 7.25%. What we are seeing, though, is we are seeing some really good incentives for first home buyers to get into the market, and some special rates for first home buyers as well as for refinances. But the battle refinancing clients are having is a lot around the valuation of their property.
Well, let's talk budget, because it's obviously out tomorrow night. And there's been a couple of leaks and teasers around tax offsets in particular. That's obviously largely seen to be stimulatory. It's expected to be a stimulatory budget. How do you think that will impact, and what would you like to see, I guess, or what would you want to see to impact consumer consumption?
So I don't think there's anything new in suggesting that the budget is very much around, the current government showing its credentials as an economic manager, as well as looking at, I suppose, the line in the sand around tax, around whether it's income tax or even tax offsets, where consumers might get a hip pocket hit before the election cycle even hits. I guess the balance they're trying to get is an election cycle budget, as well as there's consumer confidence is down, business confidence is down, business are finding it harder to access credit. In fact, the Morrison government stepped in with a small business assistance around business access to credit. So I think it'll be about getting the balance right in terms of an election cycle, the tax cuts and the tax offsets straight into the hip pocket. They're even talking about a power bill, giving handouts around power bills. So it's very much an election cycle budget. It's going back into surplus. The government's obviously trying to show its economic credentials. And the economy moving into an election phase, consumer confidence is down a little bit, and as is business confidence. There's a lot of uncertainty. So I guess they're going to want to try and bring some stability, as well as give everyone a little bit of a kick along moving into the election.
Last week, the opposition came out and suggested that their proposed changes to a raft of things, but in particular, negative gearing will be the 1st of January 2020.
That's right.
How does that impact, do you think, the property market, particularly the investment market? Do you see a rush of people trying to negatively gear before then, or do they look and say, well, if suddenly the market that I'm going to be selling into in a few years' time is less, I need to incorporate that into the price I'm willing to pay for any property that is not a new build at the moment? Yeah,
I think now that people know the drop-down date, which is the beginning of next year, I think there will be some investors who've been sitting on their hands, maybe now looking at getting back into the market to be able to secure that grandfathered negative gearing provision. I guess as well, it'll be interesting to see what plays out around new properties, and the behaviours of investors around new properties. Will we see a decline in some of those property prices where they're looking at purchasing established properties? Will we see investors hold off early in the new year when the negative gearing provisions are removed? And how will that then impact renters? Are they going to be trying to make up some of those removed benefits of negative gearing in increased rental prices? So I don't quite know if anyone really knows how that will play out, but there is some suggestion that we will see some investors who've been sitting on the sideline come back into the game and look at trying to secure those properties. And they've got about 6, 7, 8, 9 months to do that now.
It'll be really interesting actually if the Labor government gets in to see how it impacts the property market, because there's a lot of obviously changes that will happen, but a lot of unknowns as to how it will play out.
There's a lot of concern around that with investors, in property in general as well, I think.
Yeah, exactly. Anthony Landahl, we really appreciate your time on the program. I'll have to leave it there, but thank you for joining us.
Thanks for having me.
We're going to take a break. When we come back, we'll be going macro. How big and how early will any fiscal stimulus prove to be? David Bastley.